So disclosures, supplemental disclosures provide this information and are always, always required to be part of your audited financial statements. So these are called disclosure notes. So you're always going to see in your disclosure notes, I'm going to call it, I'm going to refer to it a little bit differently from what the book does, just to give you a general framework. So the first thing you always have, your first note, is always the summary of significant accounting policies. The summary of significant accounting policies is going to tell you the method that you used for everything. We depreciate our fixed assets using the straight line method of depreciation. Buildings are depreciated under 39 years. Equipment is depreciated using 10 years. Whatever. Okay, whatever it is that you do. We record our inventory using the LIFO method of inventory. We report at the lower of cost or market. Okay? These are the types of things that would be disclosed under the summary of significant accounting policies. Are your methods. Have I said anything about numbers, amounts? No, I've just told you methods. So under the summary of significant accounting policies, you're going to see methods for things, not amounts. So if you were to take a look at any financial statement, any audited financial statement, at the end, after the financial statements, you'll see footnote disclosures. Those note disclosures are going to start off with the summary of significant accounting policies, and you're going to see lots of information that tells you what methods they were used in those financial statements. But it's not going to give you what the amount was for the year. So as an example, so I told you buildings, it would say we depreciate using the straight line method, blah, 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 for buildings. For this, we use 39 years for buildings. We use 10 years for equipment. On the balance sheet, I told you a lot of times you'll see buildings, equipment, furniture, and it'll just say less accumulated depreciation. Right? It'll all be kind of clumped together. So whereas in the first note, in the summary of significant accounting policies, it'll give you some detail about how they came up with that number. In other notes, so this is how I say it. I call it summary of significant accounting policies and other notes. That's how I look at it. Okay? In the other notes, you may see a detailed breakdown. Buildings, 39 years. This was the current year's accumulated depreciation. Equipment, 10 years. This is the current year's accumulated depreciation. The total equals what's on the balance sheet. It might give you more detail than you see on the balance sheet in the other note. So you may see a fixed asset note 2 times, something related to fixed assets. The first one will tell you the method. The second one may give you more detailed breakdown of the amounts. Does that make sense? So you're going to have 2 overall categories. Summary of significant accounting policies and other notes. It's not that you're going to see only 2 notes. It's that under summary of significant accounting policies, you're going to see a note for cash and cash equivalents. It's going to say, we consider anything to be cash that has a maturity date within 3 months. That includes U.S. Treasury bills, bank accounts, money market accounts, blah, 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 blah. You may see another note that actually breaks down how much of the cash is Treasury bills, how much of it is straight cash from your bank account, how much of it is money market accounts, things like that. So you may see each of these things twice, once with a method and once with more detail, and that detail has to tie back to what's on the balance sheet. Okay? Make sense? So you're always going to see 2 overall categories. The first is the summary of significant accounting policies, and the second is going to be what I call other notes. Okay? And under other notes, there could be a whole plethora of things. I'm just giving you one idea of what can be in other notes. Yes? Yes, because and part of that is that's part of what you're auditing, right? So if you go in to audit a company and you look at their fixed asset schedule, what is one of the things you're looking at is how they depreciate, right? They're depreciating their buildings under 150 years. That doesn't make any sense. We have to give them this reasonable numbers. We have to adjust that. So you know based on auditing what these things are, based on going through, because you have to make sure they're complying with GAAP or some reasonable method that they're using. You know if you're auditing their inventory what method they're using. So, and a lot of these footnote disclosures, they're required footnote disclosures. So you already even have like a template. You know what you have to incorporate, okay? But there may be things that are not template type disclosures that have to be made. So, like I said, we always have our summary of significant accounting policies first. Next, you have to report in a footnote disclosure if there's some significant development, a subsequent event that takes place after the fiscal year end but before the financial statements are issued. So maybe there was some kind of dividend that was issued. You would report that in a footnote disclosure even though it didn't necessarily happen before the fiscal year end and doesn't necessarily get recorded in the balance sheet. Okay? If you have related party transactions, if you're making significant loans or something to related parties, you have to disclose this in your footnotes. Okay? Does that go in the summary of significant accounting policies? No. If you were to say, for all related party transactions, we have this method we allow all related party receivables to pay us back within a certain number of years, or whatever the method is that you use, or the rule is that you use, that could go into a significant accounting policy if it's something that's related to how, but not what. Okay? So the related party transaction, the detail and the dollar amounts would always be in some other note. Okay? Any contracts that you may need to, that are significant, that may need to be spelled out, would have to go into an other note. Contingencies, litigation is a very popular one. Okay, there are different levels of disclosure for litigation. Often companies are involved with lawsuits, and they don't necessarily know what the outcome of that lawsuit is going to be, but it may be material to the company's financial condition. Okay. So a lot of times what companies will do is they report in a footnote disclosure that they're in litigation. Depending upon how certain they are about the amount, they may have to report some dollar amount. Otherwise, they may just have to disclose that they're in litigation and the outcome is uncertain. Okay. You also have to report the fair value of certain financial instruments as of a certain date. So you're giving detail about information that's on the balance sheet. That's what your footnote disclosures are telling you. So again, just highlights from that. The summary of significant accounting policies includes methods, i.e. of depreciation, and the basis. Okay? How do you recognize revenue on long-term contracts? It's going to give you methods for things. It's going to give you the basis that you use, but it's not going to give you any particular number. Other notes, composition of accounts, is going to be in this other notes. And all of these other items that I discussed. Okay? If they're not methods, then they go into other notes. So I think I included here, I'll just give you a minute and then I'm going to just show you what something like this would look like. Just kind of copied this. Can I skip to the next slide? So just to show you, at the end of your financial statements, you have all your basic financial statements, balance sheet, income statement, statement of cash flow, statement of stockholders' equity. You'll see the first thing, summary of significant accounting policies, note 1. That's your first note, is your summary of significant accounting policies here. Principles of consolidation. Your cash equivalents, it considers all highly liquid investments with a maturity date of 3 months or less to be cash equivalents. Inventories are stated at the lower of cost or market, blah, blah, blah. Plant and equipment are carried at cost less accumulated depreciation. We have lives ranging from 2 to 7 years, blah, blah, blah. Revenue recognition, we recognize when payment is tendered at the point of sale. And they go through all this. So do you see any numbers in there? Just telling you. It's telling you how they derive the information that's on the financial statements. Now, this would be an example of an other note. Subsequent events. On March 8, 2013, the company's board of directors approved an increase in the annual dividend to 88 cents per share. The annual dividend will be paid in 4 quarterly installments over the course of the next year. On February 2013, they announced a purchase of a 35% interest in some other company. These are significant events that happened after the balance sheet date, but before the financial statements were reported. This is considered an other note. So this is listed as note 14 I must have pulled out from something, okay? So that means there's like a whole bunch of other notes that are considered other notes that also may have been incorporated into these financial statements. I'm just pointing out one example of an other note versus a summary of significant accounting policy. No, that's always the first note, okay? So I have here a little thing here. Let's try classifying. The summary of significant accounting policy, or is it an other note? Inventory costing method. Yes. Information on related party transactions. Composition of property, plant, and equipment. B. Composition, detail. Not method for reporting property, plant, and equipment. The detail in that account. Got it? So you may report on your balance sheet property, plant, and equipment, but not have a breakdown of what's building, what's furniture and fixtures, what the depreciation is on each of those items. You would have that possibly in another note. Okay? Depreciation method. Good. Subsequent event information. Good. Basis of revenue recognition on long-term contracts. Good. Important merger occurring after year end. Is that like an after I already give it? That's a safe bet. After the answer is up. Composition of receivables. Good. If it said method for reporting your allowance or method for reporting receivables, then it would be A. Okay? So that's really through that. Last couple of things I want to touch on before we take a break that are also part, so we could just kind of get through what's in the overall audited financial statement. So now we've gone through income statement, we've gone through balance sheet, we've gone through notes in the financial statements. We haven't gone through cash flows yet. In a financial report, an annual report, management also includes a management's discussion and analysis. You'll see this. This is management discussing the results of their operations. This is a biased report. That's what's important to understand here. It's very informative, but it's biased, and it's from the perspective of the company. Okay, their management's discussion and analysis. I have just an example of one in here. You know that we have management, since Sarbanes-Oxley, has a responsibility also to report their assessment of internal controls. This is all part of the annual report now. Okay? I'm just kind of pointing this stuff out to you. There's also an auditor's report, which we've gone through. You guys are all taking auditing. I don't want to get too much into that, but you see the auditor's report always as part of the audited financial statements. I don't think we even really need to get into this proxy statement stuff. Risk analysis, I'm going to stop here and let you take a break. I think what I'd like to do is start off after the break with the statement of cash flows, and I want to come back to risk analysis at the end.